China's economic decline is unstoppable. In order to stimulate the continuously declining economy, the Chinese government has recently introduced many fiscal and monetary policy measures. Although the stock markets in China and Hong Kong experienced a short-lived boom under the Chinese government's loose monetary policy, the rise in the stock market is only a flash in the pan without changing China's industrial economic structure and investment environment. In other words, the market value of Chinese listed companies is unlikely to increase if the trend of China's economic recession cannot be reversed. As far as the Chinese real estate market is concerned, this column has explained in the article, Reasonable Expectation of Further Decline in Chinese Real Estate Prices, that the People's Bank of China's stimulus policy for real estate is unlikely to change the trend of continued decline in Chinese real estate prices. To be fair, the main reason for this column's pessimism about China's economic prospects is that China's economy is deflationary. Of course, many people often compare China with Japan's economy, which faced deflation and insufficient demand in the past. However, in addition to the significant difference in the degree of economic development between China and Japan, the difference in the political system between democratic and communist countries will lead to major differences in economic development. This is also emphasized by Darren Acemoglu, Simon Johnson, and James A. Robinson, winners of the 2024 Nobel Prize in Economics. Political and economic systems are closely related to national prosperity. Since Deng Xiaoping's reform and opening up, changes in China's economic system have gradually improved China's economy, and people's living standards have gradually improved. Even major countries in the world have regarded China as an important export market. However, after the rise of Chinese President Xi Jinping, the credibility of China's economic and legal systems has been greatly reduced, leading to a continuous decrease in foreign investment in China. Therefore, the decline of China's economy is closely related to Xi Jinping's destruction of the legal system and economic environment. Since Mr. Xi took power, the Chinese economy has gone through many periods of complete shutdown. During the 2 years of Mr. Xi's zero-COVID policy, all trade was halted. And recently, due to many politically sensitive policies, many foreign corporations, businesses, and individuals are afraid of being held hostage in case conflicts arise. As a result, they have massively withdrawn capital and left the Chinese market. The Chinese government's destruction of the market mechanism has caused a continuous decrease in Chinese consumer demand. According to the economic data released by the National Bureau of Statistics on the 13th of this month, China's Consumer Price Index, CPI, in September increased by 0.4% year-on-year, lower than in August. Since the beginning of this year, although China's Consumer Price Index has grown better than last year, the extent of its price increase is extremely limited. When the annual growth rate of the Consumer Price Index is low, as long as the price of products with a large consumption proportion falls, the annual growth rate may be negative. In other words, China's current domestic consumption power is insufficient. When consumers expect the economy to be pessimistic, it is very difficult for government policies to produce results. In addition, the Producer Price Index, PPI, in September fell by 2.8% year-on-year, the largest drop in 6 months. China's PPI has experienced negative growth for 24 consecutive months, showing that the ex-factory prices of Chinese products are continuing to decline, closely related to China's overproduction problem. Finally, in the face of China's insufficient demand, many economic organizations and forecasting agencies have successively announced that they do not believe China's economic growth rate can reach the target of 5%. However, as the People's Bank of China and the Ministry of Finance have successively announced loose monetary and fiscal policies, the Chinese government may still stimulate the economy by introducing more funds into the market, thereby allowing China's economy to reach the target of 5%. However, as Adam Smith, the father of economics, pointed out, the reason for a country's economic growth is the level of productivity. When a country's productivity is higher, the country's economic growth will also be better. However, if the government's policies cannot achieve the effect of improving productivity or increasing research and development, the government's expansionary policies may only leave a negative impact of increased debt. Therefore, when we observe the health of China's economy, in addition to paying attention to changes in economic figures, we must also consider the opportunity cost of its policy implementation to form a more accurate judgment on the prospects of China's economy. China's third quarter GDP growth hits weakest pace since early 2023. Although the CCP often publishes dishonest figures and is often accused of fabricating them to improve the country's image, official figures released by the CCP on October 18th showed that China's economy grew by 4.6% year-on-year in the third quarter of this year, the slowest growth since early 2023. Among these, the situation in the real estate industry is particularly bad. Compared with the figures previously released by the National Bureau of Statistics of China, GDP in the first quarter of this year increased by 5.3% year-on-year, and the second quarter increased by 4.7%, while the third quarter growth rate announced on Friday further declined to 4.6%. It can be seen that even according to the data released by the CCP itself, China's economy has been below the CCP's 5% growth target for 2 consecutive quarters. In the first 3 quarters of this year, China's economic growth was only 4.8% year-on-year. The economic data released by the CCP has been questioned by the outside world for being inflated. The real estate industry is sluggish and exports are slowing down. In the first 3 quarters, China's industrial output increased by 5.8% year-on-year, and retail sales increased by 3.3%. However, real estate investment fell by 10.1% from the same period last year, and new home sales plummeted by 22.7%, showing that the real estate market is still in a state of deep adjustment and bottoming out. Because 70% of Chinese household wealth is concentrated in real estate, and the industry accounted for a quarter of the economy at its peak. These latest figures show that consumers' willingness to spend remains subdued, despite multiple rounds of policy support measures by the Communist Party of China over the past year. The real estate market shows no signs of recovery. Data on Friday showed that China's new home prices fell at the fastest pace since May 2015. China's crude steel output fell for the 4th consecutive month in September, failing to meet expectations of a rebound in construction material purchases. In addition, the key export sector, the only bright spot in the economy, has begun to show cracks, with shipment growth slowing sharply last month. Earlier this week, figures released by China Customs showed that exports slowed sharply in September, rising only 2.4% in dollar terms from a year earlier, down from 8.7% year-on-year growth in August. Imports were also weak, rising only 0.3%, both significantly below expectations. This suggests that manufacturers are slashing prices to clear inventory before multiple trading partners impose tariffs. China has always relied on infrastructure and manufacturing investment, consumption, and exports to drive economic growth, but investment has stalled, consumption has deteriorated, and now even exports have fallen. Economist: no surprises. Bruce Pang, chief economist at JLL, told Reuters, China's data for the third quarter of 2024 is not optimistic. Considering weak domestic demand, the real estate market is still struggling, and export growth is slowing, this performance is in line with market expectations. Earlier, a Reuters survey showed that economists expected China's economy to grow 4.5% year-on-year in the third quarter. The Reuters survey also showed that economists expected China's economy to grow by 4.8% in 2024, lower than Beijing's target, and growth may fall further to 4.5% in 2025. Increasing deflationary pressures. China has been dealing with deflationary pressures since the beginning of last year, and some economists believe recent data shows these pressures are increasing. As the outlook for exports, the only bright spot in the economy this year, seems to have dimmed under foreign trade restrictions by several major trading partners. The worrying weakening of export momentum has further increased pressure on Beijing to take measures to stimulate demand. The GDP data confirms that China is facing a situation of oversupply and insufficient demand. China is considered to have fallen into full-blown deflation, said Toru Nishihama, chief economist at Dai-ichi Life Research Institute in Tokyo. China has introduced a series of measures in recent weeks aimed at stimulating the economy, including lowering mortgage rates for existing homes and allowing banks to increase lending by reducing reserve requirements. However, industry insiders believe that most of these measures are piecemeal. China observers have repeatedly stressed the need for authorities to address long-term structural challenges such as overcapacity, high debt levels, and an aging population. the stock market trap that takes away the Chinese people's deposits. Recently, China's stock market has been volatile. On the evening of October 20th, 23 Shanghai and Shenzhen listed companies issued announcements that they would use the bank loans they receive for stock repurchases or share purchases. A senior accountant from the mainland warned that this was a trap. The CCP used the stock market to extract deposits from ordinary people in order to achieve this year's GDP growth target. On the evening of October 20th, 23 Shanghai and Shenzhen listed companies issued announcements stating that they had signed loan agreements with banks and would obtain bank loan quotas, which would be used for the company's stock repurchase and share purchase plans. The 23 companies, including Sinopec, China Merchants Shekou, Sinotrans, Costco Shipping Energy, and Costco Shipping Development, applied for a total of nearly 11.5 billion yuan in repurchase and share purchase loans. Among them, Sinopec signed a credit agreement with the Bank of China and obtained a loan of nearly 900 million yuan for share repurchases. China Merchants Shekou obtained a loan of 702 million yuan from China Merchants Bank to support share repurchases, etc. On the same day, Zhejiang Securities in the mainland announced that the stock market's downward trend since the 8th had ended. There is a high probability that the market will rebound at the same level on the daily line against the 3,674-point decline trend in the future. Analysis: China's stock market surge and stop are artificially manipulated by the CCP. However, Ms. Yu, a senior accountant in the mainland, is not optimistic about the new wave of the stock market becoming a so-called bull market and warns that there is a trap behind it. On October 21st, Ms. Yu told the Epoch Times that the recent surge and stop in China's stock market is artificially manipulated by the CCP. The Chinese stock market is a scam, but many ordinary people can't see the trap like outsiders. We inside the system also know that the government is now using the stock market to siphon off people's deposits in order to achieve the 5% GDP growth target. She said, now it's the fourth quarter, and they see that the GDP target of about 5% set by the top leader this year cannot be achieved. What should they do? The economy is not good, real estate is not good, and the three major drivers of GDP growth, investment, consumption, and exports, have all stalled. They've calculated the people's deposits. They think that the people have money in their pockets, but they haven't taken it out to spend. So they thought of some tricks. Asking the people to take out their money, stir up the stock market, and then GDP can increase a little. According to data from the People's Bank of China, as of the end of 2021, the total amount of deposits of Chinese residents reached 10.3 trillion yuan. The mainland's Oriental Red Asset Management released the Equity Strategy Outlook for the fourth quarter of 2024, showing that the current deposit balance of Chinese residents has increased from 10.3 trillion to 14.7 trillion. Ms. Yu said, so recently, including the top leaders, the central bank, the Ministry of Finance, etc., have come forward to endorse the stock market, saying that the first phase will invest 500 billion incremental funds into the stock market, and another 500 billion will be invested in the future, to deceive the people into entering the stock market, but in fact, they did not really take out the money all at once, but just gradually took it out bit by bit.